Hello and welcome everybody. Today we're going to be talking about Module 10, which covers analyzing leases, pensions, and income taxes. This is one of our more technical lectures of the semester, and we'll go pretty deep on each, and the accounting for leases, pensions, and income taxes can be a little bit technical, not always intuitive, so we'll try to take it slow. And please reach out to me with any questions that you might have while you're walking through the homework or the course material. And as always, for some more detailed dives into specific problems and different perspective on the material, please supplement this lecture with the course materials that are hosted on our My Business Courses website. Learning objective number one. Let's look at analyzing and interpreting lease disclosures. I think most of you probably have a good understanding of what a lease is. If you've leased a car or entered into an apartment lease, the owner of that asset is referred to as the lessor, and you, as the counterparty, is referred to as the lessee. These can be structured in a variety of different ways. These are private market contracts between two willing parties, and generally, you see there at the bottom of the screen, the two parties will adhere to certain terms. So the lessor allows the lessee the unrestricted right to use the asset during the term. So just like an auto lease, you drive it off the lot, and they're not watching where you are, what you're doing with the auto while it's out of their possession and during the terms of the lease. Usually you have periodic interest payments as opposed to one single large cash payment during the lease. You'll make monthlies, and then the title to the asset actually remains with the lessor. So even though the lessee takes possession, and for all intents and purposes, for example, in an auto lease, that would be your car, the title actually stays with the lessor. Moving on here to the reporting for pre-2019. So just like we've seen several instances of accounting standards having changed in class already this year. One of those instances was in 2019 when FASB adopted new lease accounting standards, which will take effect in 19. So for any of you analyzing cash flows and making comparisons across 18-19, if the company that you're analyzing has a good portion of its business from leases, then this will affect those numbers, and you may need to go back and adjust those so that you have accurate comparisons from one year to the next. So as of 2018, so these are the pre-2019 standards, GAAP identified two different methods whereby the lessee could report a lease on its books. And those methods are listed at the bottom of slide 4 here, the capital lease method and the operating lease method. It's the second one that's probably more familiar. The operating lease method treats a lease just like we described on slide 3. Title stays with the owner, but the owner records lease payments on a periodic basis, and it's reflective of the nature of the transaction, just like we talked about. A capital lease method requires both the lease asset and the lease liability to be reported on the balance sheet. So this looks a lot more like a capital asset purchase, and in fact that's exactly what FASB said. Under certain terms, these transactions represent a substantive purchase. So if we have legally contracted for the majority, and here I'm talking about 99% for sake of example. If if we've contracted for 99% of the useful life of a piece of material, then for all intents and purposes there, that would in fact be a purchase, and we would need to put that liability on our balance sheet. And what you see is that when you have a difference between a capital lease and an operating lease, like we've talked about so many times this semester, it introduces a level of subjectivity. And anytime there's a level of subjectivity or estimates that factor into the accounting, or the opportunity for management teams to select from two different methods of accounting, you have ultimately two different earnings per shares, you have adjusted ratios, you have different balance sheets, you have different effects on the income statement, and all of those things can affect management bonuses and pay structures and create conflicts of interests. And FASB adjusted those accounting standards for 2019 to eliminate the operating lease. So for 19, these are the 18 standards. The capital lease, the lease was reported as an asset, the lease was reported as a liability. We would record depreciation and interest expense just as if it were a purchase, and then the payments or the actual cash payments were paid in accordance with that lease contract. With the operating lease, the lease was not reported as an asset, the lease was not reported as a liability. That can be a big advantage, especially for companies who are sitting right there on that line between, say, triple B and double B, that line we talked about a couple weeks ago. That is the line of demarcation between investment grade debt and non-investment grade debt. And then there's a variety of other reasons why you might not want that lease on your balance sheet. It makes you look like you have a stronger balance sheet when you have less debt. The operating lease would record rent expense, and then lastly the payments per the lease contract. Slide number 6 is a great slide. Star this, be able to come back to it quickly on your exam, and you'll probably want it for some of your homework. But our authors walk us through some of the consequences of an operating lease, and let's go through those one by one here. So with an operating lease, remember, the lease asset is not reported on the balance sheet, so that's going to have some secondary effects. So this means that your asset turnover is going to be higher because the reported assets are lower, and the revenues are going to be affected. Let's take a look at the liability side. The liability is not reported on the balance sheet, so the balance sheet's going to measure financial leverage a little bit differently, like total liabilities and equity. Those ratios are going to be improved. You've just given the balance sheet a little facelift with an operating lease. Third item there, and without any analytical adjustments. So if you're not going back and adjusting the ROE, I think we covered ROE in Module 3, that's going to improve the quality of earnings. And our authors there say it's actually going to improve the perceived quality of earnings, which is accurate because the underlying economic truth hasn't changed at all. It's just the optics. And optics are important. I think we've touched on that a few times this semester. There's a lot of ways that you can gamify the accounting, or try to gamify the accounting, or use it in a manner that's not consistent with its original spirit and intent. And we need to know how you would go about doing that so we can spot management teams that are trying to do exactly that and maybe pad their own bottom line. So number 4 is a nuanced point. During the early years of the lease term, rent expense reported as an operating lease is going to be less the depreciation and interest reported for a capital lease. Now, later in the lease term, the rent expense is going to be greater than the depreciation and interest reported as a capital lease. We have typically a higher percentage of interest early on in the lease, and then especially if we have an accelerated depreciation schedule, we'll have a higher rate of depreciation early on in the lease. Now, both of those things ultimately flow down to net income. So in the early years of the lease, net income is going to be higher for an operating lease. So if you're take Southwest Airlines. I think that's the example that our authors use in the book of a company that has huge leases on its in its business. So if Southwest Airlines is purchasing, or rather leasing, a fleet of say 30, 50, 100 airlines, and you're the CEO of Southwest Airlines, and you get paid on earnings per share, and you know you're going to retire in a couple of years, and these airplanes have a useful life of 30 years, well, you can boost your EPS, drop more of those earnings to the bottom line, probably pad your bonus a little bit with the very simple accounting maneuver or election of treating these as an operating lease. Now you have to make sure you structure it a lot right, because the auditors are going to come in and want to make sure that it meets the standards of an operating lease. But the authors are right here. This means that net income will be higher, and it's our job to recognize the secondary effects of that. Okay, let's look at some of the criticisms. These are fairly obvious, we just went over them, but I did want to touch on the last one here. The rigidity that FASB created around the categorization of operating and capital leases was creating a disincentive for managers to book capital leases on their balance sheet. And as a matter of fact, it was actually creating an incentive either for operating leases or for managers to skirt the system altogether and create off-balance sheet structures to finance some of these leases. And these off-balance sheet structures, well, if you go all the way back to the early 2000s, well, that's what took Enron down. And they had a variety of off-balance sheet structures that were so complicated, Wall Street analysts could even hardly make heads or tails of them. And ultimately, their liabilities were revealed, and they were an order of magnitude higher than anybody thought they were. Brought the company down. There was a lot of illegal cover-ups involved with that scandal as well. But that's not the most transparent way to present financials, and FASB recognized this, and they moved to change the standard. So let's look at the new standard. Pretty simple. New standard just does away with the operating leases and requires that substantially all leases and lease obligations be recognized on the balance sheet. So if you want a new car, no more going to the auto dealership and signing a lease. Now you actually have to put the car on your balance sheet, and you got to put the liabilities on your books, which interest rates are so low. I lease my car and it works well for my family, but I'm not fooling anybody. Next month I know I have a liability and I'm going to have to write a check, and if someone else were to peer into the financial strength of my family's financial statements, that should be reflected. And I think that's exactly what FASB's telling the business community here, is that if you have liabilities that are required to run your business and they're structured as a lease, we want to see them. Put that liability on your balance sheet so that everybody in the world who looks at your balance sheet understands what it is that you're ultimately on the hook for next month and the month after that and the month after that. And it does create a kind of a greater level of transparency there. And it complicates our life a little bit as analysts, because when the standard changes, our numbers are not always comparable across time periods. So we need to know how that works so we can make those adjustments. And certainly if any of you are analyzing a company like Southwest Airlines, where this absolutely would be material, you're going to need to make these adjustments for your semester research project. Okay, let's take a deeper dive into the new standard, and this is where the new standard drives me a little crazy. Just not in the accounting or the standard itself, but in the terminology. So you'll see here that even in the new standard, we have two types of leases. And one of those types is named exactly the same thing as the old type, but it's not the old type, It's the new type. And what I'm referring to here is this operating lease. So under the old standard, we had something that was called an operating lease. And under the new standard, we have something that's called an operating lease. But they're not the same thing. So good luck keeping those two things straight. I wish I had a simple rule of thumb for you, but I haven't come up with a good one yet. If any of you guys come up with a good rule of thumb for keeping the old operating lease separate from the new operating lease standards, let me know and I'll include it in my class lectures. But man, just FASB's making it hard on us accounting students that are trying to understand the change and keep these two things straight. So with that disclaimer at the top, let's go into the new standard and talk a little bit about what makes a financing lease different from an operating lease in the new standard. Okay, so here we are. We're in the 2019 new standard. We're effectively classifying all lease as capitalized. So capitalized means that we're putting the asset and the liabilities on our books just like we talked about. Once we've done that, we're going to differentiate how we treat the income statement side of that equation. So when do we book the lease revenue and in what amounts? So a finance lease, where the lease transfers control of the asset to the lessee, so looks a lot more like a purchase, is a finance lease. An operating lease is one where the lessee controls only the use of the lease asset, but not the asset itself. So the title always stays with the lessee. Okay, the term operating lease in the new standard is different from the use of that in the current standard, like we just talked about, and just kind of star these bullet points. It no longer refers to whether the lease is capitalized or not, because effectively all leases are capitalized. Now it only refers to the lease expense, and here's the differentiation at the bottom of the slide. The lease expense for an operating lease is simple. We're just going to take, on a straight line basis, the total sum of the lease payments. So if we're paying $500 a month for a car, and we got 12 months in a year, that's $6,000 a year. If it's on a 5-year term, well, 6,000 times 5 years is $72,000. So that's the total amount of payments that we're going to make for that lease over the life of the term. And well, I kind of already backed into it. Our lease expense is going to be exactly that, $500 a month. No depreciation, no interest, no anything like that which would otherwise and normally accompany an asset purchase. Now contrast that to a finance lease, which is exactly what we would have to record if we had bought the vehicle. We would have interest and we would have depreciation. So for a finance lease, we're going to record interest and we're going to record depreciation. And that's right down here in the last bullet point. So this is an important slide too. These slides, 8 and 9, you're going to want to be able to come back to. So interest expense on the lease obligation. The lease expense for financing leases is generally higher in the early years of the lease and lower in the later years. So we just talked about that with a capitalized lease in the old standard. So a capitalized lease and a finance lease, old standard and new standard, they function similarly as it affects the income statement. So remember that and be able to recall that. Okay, what's the difference? As is typical, FASB gives us some guidance for what's the difference between an operating and a finance lease, and we have several tests here, so let's go through those one by one. Lessors will assess finance versus operating lease by looking at whether or not the lease transfers title, and we're actually looking for the distinction of a major part of the economic life. So in this instance, we used to use 75%, but now we use quote unquote major part. So 75%, probably still a good rule of thumb. That's what companies and analysts and auditors have been using for the last decade under the new standards when auditors come in and they're trying to figure out whether or not this should be a finance lease or an operating lease. Yeah, that 75% line still matters, but it could be 65% or it could be 85%. What's a major part? And major part there is going to be determined, partially through the same lens that we view everything in accounting, which is whether or not it's material. If we record a lease as a operating lease at 65% versus 85%, what's the effect on earnings per share? What's the effect on the ratios? What's the effect on the income statement? What's the effect on the balance sheet? These are the questions that auditors are going to be asking. If those effects are immaterial, then it doesn't matter as much as if they were material. If they were material, then there's going to be a much more detailed, potentially contentious discussion around where to draw that line. Point number 2, the present value of the lease payments comprises substantially all of the fair value of the lease asset. New standard uses the language, quote unquote, substantially all, much more subjective than the old standard, which used a clear line of 90%. So same comments apply to the second standard as the first standard. Probably using some historical reference plus some estimate of materiality to determine how to record that. Number 3, the lease transfers ownership of the asset to the lessee. That looks a lot more like a purchase, easier to understand. And finally, number 4, the lease grants the lessee an option to purchase. This is called a purchase option, and you may have heard this referred to as a bargain purchase option in prior accounting classes. If that's there, it's going to require scrutiny, and if it is likely that that option will be exercised, then that lease is going to need to be recorded as a finance lease. Okay, let's take a look at the footnotes. Just like with everything else in accounting, all of the best detail is disclosed in the footnotes. So when we're using an old standard and trying to make the face of the income statement or balance sheet look a little better like we just talked about, well, even in that circumstances, you as the analyst typically do have access to the information. It's just a little harder to get at because it's not on the face. We don't have as much visibility. We have to do a little bit more digging. We have to understand where the disclosure is, and we have to be able to read the fine print. That's exactly what we have here. This is the table that you're going to find in the back of the 10K. This is for Southwest Airlines. You're going to see capital leases and operating leases disclosed for the last 4 or 5 years, and then subsequently what those liabilities are going to be in the next few years, the total of those lease payments, and that's going to give you as an analyst that's skilled in accounting and has taken financial statement analysis the opportunity to really understand what's going on, and that's terrific because it allows us as the analysts to really create value for whoever it is that we're working for. As a stock analyst, you have an opportunity to discern different types of investments. As a bank credit analyst, you absolutely must know this information because it changes the credit quality of an institution. As a business analyst working perhaps directly for Southwest Airlines in this instance, you need to know for your own internal capital budgeting forecasts. You may want to be able to compare your financial statement strength and wherewithal to that of a competitor for mergers and acquisitions. You just need to know this stuff. So look for this in the back of your 10K. If it's material, absolutely go in depth for your semester research project, and let me know if you need a little help with this, because this can be one of the trickier aspects of our certainly lecture and class this semester. Okay, let's get into the heavy lifting because all new leases are required to be capitalized. When we're looking at prior reporting periods, we may have a discrepancy in the accounting, and we're going to need to adjust for that. And adjusting for that is called constructive capitalization. And all constructive capitalization means is that we're going to go back, look at all the financials from prior periods, and adjust those financials so that the operating leases are recorded as capital leases. Now, how do we do that? Well, we have to take the value of those operating leases and treat them as if that equipment was actually purchased, meaning that value is now going to be recorded on the balance sheet as an asset and on the balance sheet as a liability. And we're going to adjust the income statement to accurately reflect what we would have paid in interest and what we would have recorded in depreciation for that asset. That interest and depreciation is going to flow through to ultimately net income, to earnings per share, and all of our financial ratios are similarly going to be affected. So you can see here authors give us some examples of what failure to capitalize operating leases does to our financials. So when we fail to do this, we're going to end up with distortions. And those distortions are going to look like this. Operating profit margin is going to be understated, our asset turnover is going to be overstated, and our financial leverage is going to be understated. And we talked about a couple of those already, but we can look in more detail at the mechanics of how we would go about doing this. And I don't expect this to be widespread, the prevalence. I don't expect most of you to have to do this for your semester research projects because it's not going to be material. But certainly, if you're looking at a company like Southwest Airlines, yeah, it's absolutely going to be material. So you need to know how to do this. It will crop up on the homework, and you'll probably get some questions about this on the exam. So let's go through and look at the step-by-step step-by-step of how you would go about doing this. And you may want to star this slide 13 because we already looked at the disclosures, so we know what the future lease payments are going to be. And when we know what those future lease payments are going to be, we can discount those back to the current time period, and that will represent our present value, and then the present value is going to be the value of the asset and the liability that we put on the balance sheet. So to do that, step number one, we have to determine the discount rate. Well, how are we going to determine the discount rate? Well, you recall our company has a marginal cost of borrowing that we've looked at in the past. If we were to actually go out and buy this piece of equipment, that's probably going to be the interest rate that we would have to pay in the market. So that's going to be one frame of reference that we would use to help us determine the discount rate. Alternatively, we could just go to market. We could go to market and ask, if we wanted to buy this piece of equipment today, what kind of rate could we get? That's pretty easy. If you're looking at a new car, for example, just think about this from your own personal aspect. Well, you just pick up the phone and you call the car dealer and you say, what kind of rates you got for a new lease right now? And he's going to say, it's a great time to come in and lease a car. We can give you leases as low as sometimes 0% financing. You saw that in the last few years. Now it's probably 1, 2, 3%. So you're just doing a market check. That's another way to determine your discount rate. Once you have that discount rate, we're going to compute the present value of the future lease payments. We've covered that several times in class. Should have covered that in finance prereq as well. And then we're going to adjust the balance sheet to include those present value amounts. Okay, because this is a little bit technical, let's walk through it step by step in detail to make sure we all have a good understanding of exactly how we would go through this constructive capitalization process. So, step one, what's our interest rate? There's a couple of ways we can do this that I just mentioned. We can impute the implicit rate of return by looking at other capital leases on the company's balance sheet. So Southwest Airlines just disclosed what their capital leases were. We know what the leases are recorded at on the balance sheet. We know what the expected future capital payments are. Those have all been given to us. Well, if we know the future payments and we know the present value, we can impute, meaning calculate, what the interest rate is that's required to make all those things balance. Alternatively, we could just look at the company's marginal cost of borrowing, like I just mentioned. What's their credit rating, and what's the likely cost of borrowing if they went out to the credit markets to buy all these planes? That's probably the easier method. You just look up what they're paying today and use that as your interest rate. So that's one way to do it. If you're going to use the first method, if you're going to impute it, this is what that would look like. You take all the cash flow payments that we just looked at on the prior disclosure, you type them into an Excel spreadsheet. So we know that Southwest Airlines has $209 million worth of lease payments that they're going to be required to pay in the next 5 years. We know that they're currently at a run rate of about $44 million a year, so you type in $44 million for years 6, 7, 8, and 9, and that leaves you 33 to pay off in year 10. We know that the balance sheet currently has assets at 365 million. So you type all that in there, use this formula. Formula for the cell equals the IRR, that's your internal rate of return, of B2, that's your current value, and then L2 through L10 would be your cash flow payments. If you use that formula, it's going to give you the interest rate back that would require all those cash flows to basically equal. And in this example, that internal rate of return is 3.94. So we've just calculated the appropriate discount rate for this problem. Now let's use that discount rate to determine our present value. This is an operating lease. We know what the lease payments are going to be over the period of the operating lease. Let's take those lease payments and discount them back to the current time period using that discount rate. And we've done this several times already. Here's our operating lease in column B. In year 1, we expect to pay $557 million. Fast forward to year 2, 3, 4, 5, we have our lease payments all the way down. In each of those years, we want to discount that payment back to the present value. So in this instance, our authors are using the discount factor tables, which you can find in the back of your book, and the interest rate of 0.394. It's easier to use a financial calculator, or you can use a spreadsheet. And if you use a spreadsheet, here's your formula in column E. Present value equals B10, which is your interest rate, times A3, which is your payment, and B3, which is your number of years that you're discounting back for. Column D is the number that we're really after, which is the present value of each of those payments. Add those up, and we get 3.1 billion. 3.1 billion is the value of the asset that we need to put on our balance sheet, and it's the corresponding value of the liability that we need to put on the liability side of our balance sheet. And then as we record the interest expense and depreciation associated with this number, we're going to use that same discount rate, 3.94, to calculate that. So look what happens when we take that 3.188 billion and put it on Southwest's balance sheet. I think we're still looking at Southwest here. Our total assets go from 21 billion to 24 billion. Our total liabilities go from 13 billion to 17 billion. That's a big change. We just increased that by almost 30%. So very material and very significant. And look to see what happens to our ratios down here. Profit margin doesn't change, but look at asset turnover. Asset turnover goes from 0.93 to 0.81. Return on assets goes from 10.2 to 8.9. Financial leverage goes from 2.9 to 3.3, and then return on equity stays the same. So earlier in the semester, especially when we were looking at credit ratings, we saw a table that illustrated kind of ballpark or average ratios across different ratings. So companies that were AAA, AA, single A, and you saw their ratios just kind of deteriorate as you moved down towards higher yielding debt. And that's exactly what happened here, which is illustrative of just how important it is to be able to go through this constructive capitalization process for some of these companies. Okay, so now as you probably observed, the return on equity numbers were unaffected by the analysis that we just went through there. It was 29.6 either way, but the constituent components of return on equity change significantly, which are return on assets and financial leverage. So as you'll recall from Module 3, I think it was, when we broke down return on equity, the to the degree that return on equity is driven by return on assets, we call that a higher quality of earnings. And in this instance, when we constructively capitalize these leases, return on assets declines and leverage ratio goes up. So while return on equity doesn't change at all, we can see by comparing the constituent components that the quality of earnings drops significantly, which is really important to us as analysts when understanding the economics of a company. Okay, now recall from an earlier module, we also looked at ROE through the perspective of operating versus non-operating assets and liabilities. So let's put that hat on for just a minute and see how these adjustments would affect our balance sheet from that standpoint. The exercise that we just went through added the present value of those lease payments to operating assets. We're going to take the present value of those lease payments and add the debt to long-term liabilities, which are non-operating liabilities. So that's an important distinction. Now let's look at the income statement side of the adjustments. We're going to add depreciation expense to the income statement, whereas before we might have had rent expense or lease expense. That's an operating expense, and we're going to compute that as the 3.188 million, which was our present value, divided by almost 10 years. And then we're going to add interest expense to that. So we have depreciation expense and we have interest expense, and we're going to remove the rent expense, which was formerly on our income statement. So now you can see the adjustments that we just went through here. We looked at the adjustments to the balance sheet a moment ago. We have non-operating assets and net operating assets and net non-operating obligations, which were adjusted by the 3 billion present value. And now we have the adjustments to our income statement, which is 79 million in net operating profit after tax, so our NOPAT is affected, and our net non-operating expense is similarly affected, and you can see there that's notes E and F. So note E, we're looking at that rent expense and we're subtracting the 319 depreciation expense. So we took rent expense off our books, we added depreciation expense, and then we multiplied that times our, you'll recall, our interest expense tax shield. And you have to go back to module 3 or 4 when we covered NOPAT to find that formula. In note F, we have the 126 million times our interest tax shield equals the 79 million in additional after-tax interest expense on capitalized lease obligations. And on slide 20 here, you see the net effects, and we've touched on some of these effects already here, but our return on net operating assets, net operating profit margin goes from 11.3 to 11.7. So that was more than offset by the lower net operating asset turnover. All in all, the sum total of Southwest's adjusted figures here, we have more assets, we have more financial leverage, and that was just a difference from what we reported before. So be familiar with the net effects, understand how to go through that constructive capitalization process, and it's likely to show up on the exam in multiple choice form by asking you to go through that process and then select the adjusted ratios. So be familiar with how to do that, and you'll see that on some of your homework assignments and sample tests. Moving on, let's analyze and interpret pension disclosures. Let's talk about pension benefits. First, we need to know the different kinds of pension plans. We're talking about defined contribution plans, so think of these as 401k plans. Most of you have probably heard of, been enrolled in, or semi-familiar with 401k plans. On a periodic basis, your employer is going to take some salary contributions and stick them over in what's called a 401k trust. That's usually held by Fidelity or Schwab or another major custodian. You get to log in, you direct those investments to a menu of investments that have typically been selected on your behalf. If you do nothing, you might end up in what's called a target date fund, and those monies sit and grow for you until you retire, at which point you take them out to live on. And that's a pretty simple system when it comes to the accounting. On a periodic basis, when we record wages expense, we're also going to record an expense to fund that 401k plan. And that's the easier of the two. The accounting gets a little complicated when we start looking at defined benefit plans, because these are entirely different from the employer's perspective, because rather than contributing every paycheck with your wages, what we're actually doing is accounting for a liability that we've promised our employees at a point in the future. And that can be at a point 30 years in the future. So most of you probably have, I don't know, an aunt, uncle, mom, dad, grandma, grandpa. I'll just use me personally as an example. My grandfather, who has passed away, but he spent his nearly 30 years working for a pipeline company. So this was Phillips 66 that has since been bought by ConocoPhillips, and probably be bought again here in the next few years. Who knows? But the basic deal when he was working was that the company had promised him, and this was very common in his age. Fortune 500 companies, big companies, would promise their workers as an incentive and to get them to stick around, retirement benefits. But they never logged in a day in their life to their 401k account to see how their account was doing. They just knew with confidence that when they hit age 65, their retirement age, or whatever, that they were going to start getting a retirement check in the mail. And that benefit was usually based on some percentage of their salary in the last years they were working. It's very common to see a plan set up to where a worker would receive 80% of the paycheck, their average paycheck in their final 3 years. And that was a great system. It worked for somebody like my granddad, who retired in, I think he retired in 1985. He started getting a check in the mail every month, and that came with medical benefits. And my grandmother, who's still alive, continues to get those checks. So think about what that means, and think about what that means from a liability perspective, and then we're going to take a deep dive into what that means from an accounting perspective. Phillips 66, on their side of the equation, had made a promise to my grandfather that they would pay him every month beginning in 1985. Well, just count the decades. You go 1 decade to 95, 2 decades to 05, 3 decades to 15. Now we're almost 35 years into that basic bargain, and they're still striking checks. So from an accounting aspect, when we're looking at a defined benefit plan, we have to be able to accurately record the liability that's on a company's books when they've made these promises, and when they've made these promises to generations of workers over the last 10, 20, 30 years, and we have to make assumptions about how long those promises are going to last. And those assumptions are built on things like salary, what we expect salaries to be when employees retire, what we expect inflation to do, what we expect interest rates to do, what we expect longevity to be, because these payments last until death, so it matters whether or not somebody's living to age 70 or age 100, what spousal benefits are going to be, and then we have to do the same thing for any medical benefits that accompany that. And as you can imagine, this introduces, well, from a sensitivity analysis perspective, which we'll look at, you can get wild swings in the present value of these long-dated liabilities. And because you can get wild swings in the present value of these long-dated liabilities, they can have an outsized effect on the income statement. So FASB recognizes this, and they have some very and they have some rules to address it. And in this learning objective, we're going to go through those rules and analyze just how they affect the financial statements. So I talked about defined contribution plans. I'm not going to spend a whole lot of time on it in this lecture because that's the simple one. We're simply going to accrue a wages payable for a defined contribution plan. Remember, it's the defined benefit plan that gets complicated because that's the future benefit that creates the liability associated with the retirement plan, and it's that future benefit that can get so large and require so many estimates for us to accurately record on the balance sheet. And here our authors are noting accurately that these can be paid 30 to 40 years in the future, which is exactly the example that I went through. So these estimates are difficult and prone to error, as our authors tell us here on slide number 24. And the complication of, or rather the calculation of the amount of cash that we need to set aside to fulfill these liabilities can be complicated, and because it can be complicated and because those liabilities are so many years in the future, it can be very tempting for management teams not to set the cash aside because they have other things they want to do with that cash. They want to fund internal initiatives. They want to drive the company forward. They want to produce growth. They want to do all the things that make the company look successful and ultimately get them paid, and rarely is setting money aside to pay future retiree benefits consistent with those goals. It's entirely consistent with the virtue of prudence, but you've seen many management teams drive their defined benefit plans into the ground because of that very basic conflict of interest. So FASB has some rules around how long that plans can remain underfunded, and they have an insurance program called the Pension Benefit Guaranty Corp that requires companies to pay in to collectively insure any mismanagement that comes out of some of these plans. So just like with everything else, when we have subjectivity in the accounting, which our authors note here at the bottom of slide number 24, we're going to see footnote disclosures, and we're going to look at those, and we're going to analyze how to pick those apart a little bit and appropriately adjust the financials when we need to adjust the financials. Okay, let's look at some of the terminology. That liability associated with the basic transaction that I just described there is called the projected benefit obligation. So how much money are we going to have to pay our retirees, and over what period of time, and how many retirees, and the estimates that or factors that go into that projected benefit obligation are listed right here in the blue bullet points. So we need to know the number of employees who will reach retirement age while employed with the company. We need to know their salary levels at retirement. This requires an estimate of wage inflation, and not only just wage inflation, but if we have somebody that's 30 years old and we expect that that person might work until she's 65 years old, we need an estimate of salary inflation too, because she's likely to get promoted over a period of time, and her salary at age 30 is not going to match the salary at age 65. So you have a component of inflation, you have a component of wage inflation, but then you have a component of that person's climbing the ladder and making more money over time, and those are all factored in there. You need years of service at retirement, and then you also need the years over which the annual payments will be made. So very long-lived liabilities. And all these things are going to come together to help us factor and calculate our projected benefit obligation. So once we have some idea about what the total number and amount of cash flow payments are likely to be, we're going to discount those back to the current time period, and we're going to use a discount rate that we call the settlement rate. And as you'll see, that settlement rate or that discount rate is very subject to sensitivity analysis. So if we discount that back at 3% or 4% or 5%, we're going to get a much larger or smaller projected benefit obligation. So the smaller that discount rate is, the larger that projected benefit obligation is. basic equation for determining how funded or underfunded our pension plan is to look at that projected benefit obligation in comparison to the pension plan assets. So in round numbers, if we go through the calculation of identifying all those inputs and discounting them back to present value, and we come up with a projected benefit obligation or liability of $100 million. And we compare that to the pension plan assets that we've put in the bank of $100 million, we would call that pension plan 100% funded. Now, to the extent that you see pension plan assets less than the projected benefit obligation, we're going to call that underfunded. And if you look at across most defined benefit pension plans, most of them are underfunded, and most of them are, I'm going to say, between 60 and 80% funded. And you need to find this ratio for the company that you're analyzing this semester. If your company has a funded ratio that's less than 70, less than 60, certainly less than 50, well, that ought to raise a little pink flag. And you need to be asking questions about what the plan is there, because the company may be required to make significant contributions to that pension plan in the future to shore it up. And that's going to require cash. And you as the analyst need to know, where's that cash going to come from? What's the plan? How it's going to be generated? Is it going to call into question some of the other strategic initiatives that the company has launched in the last few years to drive productivity gains and sales growth and ultimately earnings? And how does it compare to some of your competitors in the industry? And does this cripple their position or put them at some competitive disadvantage relative to some of their competition who might not have these types of other obligations on their books? And as you'll see, sometimes you have to do some digging into the fine print to get a handle on just how big those obligations are. So let's dig a little deeper and look at that. That funded status is going to be key to something that we call pension expense. On a periodic basis, just like wage expense, just like a defined contribution plan, we need to be contributing monies to a defined benefit plan. The challenge is how much money, because these obligations are much more challenging to really get a handle on, and they have a tendency to fluctuate up and down quite a bit. So we have some formulas that we're going to use to calculate this pension expense, but if we simplify it a little bit, we really just need to recognize that the closer our plan is to fully funded, the less that pension expense is going to be. When our plan starts to become underfunded and the obligation outweighs the assets, we're going to be required to chip in a little bit more on a periodic basis, and that pension expense is going to get larger. So the same basic math that we just walked through, if our company's plan is underfunded, we're going to need to fund that. That's going to require cash, and that cash is going to be booked on our financial statements, and it's going to show up in a line item called pension expense, and we need to be able to forecast that, account for it, and work that into our forecast of future cash flows. Let's dig in a little bit on the pension plan asset side of the equation. We looked at the PBO and all of the estimates that were required to calculate the PBO. The asset side usually sits in stocks and bonds. We take those pension plan expenses, we put those cash flows into a stock and bond account, and those are going to grow over time. And we have a forecast for how those are going to grow. But let's look at the formula. So we have our beginning balance plus the actual return on investments. So this year the market's up, say for example, it's up 10%. So that would be actual returns on investments. We're going to add to that the company contributions to the pension plan, and then we're going to subtract from that the benefits paid to retirees. And then at the end of the period, we're going to have an ending balance for pension plan assets, and that's going to help us determine what our funded status is at the end of the period. So our actual returns, company contributions, benefit payments, those are pretty much exactly what they sound like. I will just note that the actual returns can fluctuate significantly. So imagine the Great Recession. Rewind back to 2007, 2008, 2009. from peak to trough, the markets were down almost 50%. So for a company like ConocoPhillips, or another big blue chip company that has billions, maybe tens of billions in pension plan liabilities and pension plan assets associated with their plan, a 50% decline can result in a loss in the tens of billions of dollars. And we're going to look at some rules here that FASB gives us for how to account for something like that. Because one of the concerns from an accountant's perspective is that fluctuations that large can distort the financial statements. And we've talked about that several times this semester when we encounter those instances in accounting. FASB gives us some techniques, some smoothing mechanisms. As you'll see here, some of those gains and losses will end up in accumulated other comprehensive income, which is a category of income for exactly this type of instance. So let's move on and talk a little bit about that. The calculation of pension plan liabilities, or the PBO, I'm just going to refer to it as the PBO. You can see here that we have the beginning balance of PBO plus the service cost. So service cost is the wage inflation that we talked about, plus the interest cost. So we had a settlement rate associated with those assets, which was the discount rate. That corresponds to the interest cost, plus actuarial gains and losses. Maybe we change the benefits associated with the plan, or maybe the actuaries look at the health of the workers in the plan, and they come to the conclusion that it's likely they're going to end up living on average to 95 instead of 90. Well, that's a big difference, and we're going to need to adjust for that liability. And then lastly, we're going to subtract off any benefits paid to retirees, and the net cost of those, or the net of those adjustments there is going to be our end of period balance for pension plan liabilities. Take the assets, compare them to the obligation to get funded status, like we've talked about, and you're going to have the effects of that flow through to the income statement and balance sheet. As those effects flow through to the income statement, you're going to see our pension expense comprised of 4 components. The service cost we just talked about, so we have an element of wage inflation built into these assumptions, and every year we're going to need to account for that. Interest cost, again, that's associated with the settlement rate that we talked about earlier. So service and interest costs are going to show up at their face value, meaning we're going to calculate those every year, and we're going to book them on the income statement. Now we're also going to partially book the expected return on pension assets. And let me get into this a little bit, because I said partially booked, and what I meant to say was we're going to book that expected return. Now that's different from the actual return, and there's a reason for that. And it goes back to what I just said. When you get a market environment like the Great Recession, you can have wild swings in the value of those assets. So rather than book the actual return on plan assets, we're going to book the expected return. And the expected return is going to be disclosed in the fine print, in the 10K. And you need to know what that expected return is. Because if that expected return is, well, call it 15%, that's a little bit unreasonable. So we need to make sure that whatever that expected return is, it's in a range of reasonableness. And that's what's going to help us book the actual pension expense on a periodic basis. And then lastly, number 4, we're going to amortize certain amounts. And one of the amounts that we amortize, and this is a smoothing technique, are all the prior differences between expected return and actual return. So expected return is a smoothing technique, and then we'll amortize the total difference between expected and actual. And what you see over time is, and this is exactly what happened in the Great Recession, you saw a 50% loss followed by a 20% gain, a 20% gain, and a 20% gain, or thereabouts. The market went up 300% in the next 10 years. Those wild gyrations have a tendency to counterbalance themselves over time. FASB has recognized this, and with these smoothing techniques, it allows for a greater usefulness in analyzing the financial statements, and then we can always look through to the disclosures in the 10K filing to understand what the real-time effects of those are. And we put any differences between those amortized and accumulated down here into the other comprehensive income, just like I mentioned a moment ago. And then when you dig in on that fourth component, which is the amortization of deferred amounts, you're going to find that they primarily arise from two sources. The first source is the change in actuarial assumptions, and then the second source is the unexpected return on pension plan assets. Both of those go into accumulated other comprehensive income and are amortized over time, so that balance would be adjusted downward. Our author's note on slide 33 here that we don't have to use this accounting. We don't have to use the accounting that smooths out these wild fluctuations in market returns and actuarial assumptions associated with these benefits. We can use fair value accounting, which means that we push through the net changes to the underlying value of these assets. It can create distortions, and the example that the authors give here is of AT&T. Here's the profit on the reporting of their pensions at fair value. So you can see that in the millions, so we had a loss of $2 billion, a loss of $4 billion, a loss of $8 billion. These are, again, huge distortions. Then we have a gain of nearly $8 billion in 2013, followed by a loss of $8 billion in 2014. So if you're a stockholder of AT&T and you see this, it's got to be a little bit of a head scratcher. And if they're passing all those gains and losses through the income statement, well, you're going to get more volatility. And more volatility to an educated accountant that knows what's going on is no big deal. But more volatility to your average shareholder who's, I don't know, worked for the company or maybe got inherited stock or just holds this inside of a 401k, that can produce some anxiety, because it looks like there's a lot of fluctuation in the earnings, and that doesn't give you as much confidence in either the management or the strength, the operating strength of the business. So we just need to know what's going on there, and if the company is using fair value accounting or passing those gains and losses through, then we need to be aware of just what kind of distortions that can lead to. Here's another example with General Electric. You see General Electric's funded status here, either green or red, and then the pension cost. Well, when you have funded status that's, looks like they're $15 billion overfunded in 2001, that coincides with the trough of their pension expense. And as a matter of fact here, you see that their pension expense wasn't a pension expense at all. It was a net gain. Makes their earnings look a lot better. When we go through the Great Recession there in 2007, you see that the funded status of their pension plan moved from a net funded ratio of 15 billion all the way down to a net unfunded ratio in 2015 of 20 billion underfunded. Their pension expense rises as a result of the smoothing mechanisms and the amortization of those losses, funded status, and any actuarial gains associated with the accounting. And that creates a drag on earnings going forward. So we need to be aware of just how that affects the financial statements. Look for this table in the disclosures of your 10K filing, and look for materiality. If this is significant, you're going to need to be able to explain the components of pension cost. These are disclosed. I think this example is for FedEx. You can see the service costs, interest costs, actuarial costs, all of the components that we just went through will be disclosed in a table like this in the back of your 10K filing. Same thing for pension expense. You're going to see those laid out in a similar table. You're going to be able to analyze the components, and you're going to see that back for a few years, 13, 14, and 15 in this case. And you can see how the actual rate of return fluctuates with the expected rate of return. then I think I've covered all of the points on slide 38 here. These major components determine pension expense. The company has some discretion over how fast they fund that, as long as they stay within certain guardrails. Affects cash flows. Yeah, we've talked about all of those. Another disclosure that you'll see in the financials are the pension plans, the benefits disclosure. So these are the benefits that the company expects to pay over the next 5 years and beyond. So you have some frame of reference of what the exact cash flows will be going out the door, which is crucial for any sort of liquidity or solvency analysis. So look for that and factor that into the overall health of your company as you're thinking about how they're going to meet these obligations going forward. You'll also see keynote disclosures. So as we're kind of moving through the disclosures that are associated with all these pension plans and the mechanics of the way they work. And we touched on all these, but you're going to see each of these major assumptions disclosed in a table that looks like this. So I think we're still looking at FedEx here. The discount rate used to determine benefit obligations, so this would be that PBO. So the discount rate that they use is 4.4, 4.6, 4.7. That falls within a range of reasonableness. We ought to be able to put our assets to work at a rate of 4.4, 4.6, or 4.7. Over the long run, the stock markets have generated, on average, over the last 100 years, call it 9, 10%, depending on exactly where you start and exactly where you end. So for argument's sake, let's just round up and call it 10%. Now, most pension plans are not invested quite that aggressively. They use some combination of stocks and bonds, and the long run average of bonds has been about 3% real. So add a couple of percentage points for inflation on top of that and just call it 5%. So if you're half and half, then what would be expected would be 7.5% rate of return. Now, given the environment where we are, we're 10 years into a bull market, so we don't have the greatest jumping off point, and current interest rates are low. The 10 years at 2. So you need to adjust both of those downward a little bit. So rather than the long run average for stocks being 10, probably need to dial that back to around, I'd say probably 6 or 7. And then if you have the 10-year interest rate at 2%, that's a proxy for fixed income. Let's just call that 3 when you mix in a little corporate debt. So now you have 6 for equities, 3 for bonds. You're taking an average of those to get you about 4.5. That's where FedEx is in this example. Okay, great. So we have reasonable expectations. Look at the second one. Discount rate determined to determine net periodic benefit costs. So this is pension expense. And those two things, should be roughly equal. The rate of increase in future compensation levels used to determine benefit obligations. So this is that wage expense we were talking about. It should be an inflationary plus a little bit more. Rate of increase in future compensation levels used to determine net periodic benefit cost. So this is on the income statement. And again, those two things should match a little bit. You can see here that in 13, the 4.79 for the balance sheet flows through to the 4.79 for the income statement. So those two things match. They should flow. And then lastly, the expected long-term rate of return on assets, which is the income statement. There we have expected long run 8, 7, 7. Okay. Let me move on here. Changes in pensions assumptions. This flows through, this was the 4th component of pension expense. Periodically we'll change the actuarial assumptions that go into the calculation of the projected benefit obligation. When we do so, we're going to get a big change in that obligation, and that change in that obligation is going to be amortized over time. And here's the effects. This is a good table to star because it's likely to show up in multiple choice format on the exam or in homework. So when we increase the discount rate, are we going to get a higher or lower effect on the pension expense? Well, it could be higher, it could be lower, and this is the reason for the effect. So while the higher discount rate reduces the PBO, the lower PBO is multiplied by a higher rate when the company computes the interest component of pension expense. The net effect is therefore indeterminate. Okay. Investment return is going to lower pension expense. So the dollar amount of expected return on plan assets is the product of the plan assets and the expected long-term rate of return. Increasing the return increases the expected return on plan assets, thus reducing pension expense. Okay, wage inflation. If we assume that's going to rise, then that's going to increase our pension expense. The expected rate of wage inflation affects future wage levels that determine expected pension payments. An increase thus increases PBO, which increases both service and interest cost. So that's a challenge. We got a lot of moving components in this pension plan expense. You're going to want to go through these slides several times to make sure you have a general understanding of, one, the nomenclature, how they function together, whether or not they end up on the income statement or balance sheet, whether or not they end up in the actual net income, pension expense would flow through the net income, or whether they're amortized over time as a component of accumulated other comprehensive income. That's a lot. This is challenging stuff, and if it's the first time you've been exposed to it, it's going to take a little bit of work. So dig into the details, understand whether or not that's material for the company that you're looking at, and let me know if I can help you sort that out. And looking on slide number 42 here, I think we've covered all this. Once you get into the analysis, you need to understand what the pension plan is going to do to future financing needs. You need to understand the effect on profitability. You need to understand whether or not these costs should be treated as operating or non-operating, just like the analysis that we went through for leases. Pension expense is going to have similar effects, and we need to understand those. You need to understand where the funds are going to come from. Need to understand if the investment returns are going to be sufficient or insufficient, which was the same analysis that I just walked us through, and comparing the assumptions to long-run market rates of return with some context for where we are in the current market cycle. You see a lot of companies adjusting downward their assumptions for future market returns, and when they do that, their PBO goes way up. Pensions are one of the primary buyers right now of equities in the market. If you look at where the market is, a lot of pensions are underfunded. That's caused them to take on more risk, and the way you take on more risk is to buy more equities, because historically those have returned a higher rate of return. But buying more equities 10 years into a bull market can be a very aggressive thing to do. So you're putting those benefits and ultimately the retirement plans of those employees at greater risk, and that has effects, and we need to be aware of what those can be, and prepared for the cash flows that might be necessary to shore up those pension plans in future periods. Slide number 44 is a good one for the common theme of this class, which is how would you gamify the system? If you're a CEO or a CFO trying to find that extra penny to meet earnings forecasts, then you might tinker with some of the assumptions that go into these calculations, and one of the assumptions that has a direct flow through to pension expense is the expected rate of return on those assets in the market. So if you tinker with that expected return, you might be able to find a penny there. So just be mindful of how those expectations and assumptions are flowing through to those major line items. And then where do these end up on the income statement and balance sheet? Are these operating items? Are these non-operating items? Are these going to flow through to your return on operating assets? Just like we looked at with leases, these can affect the quality of our accounting and the quality of operating versus non-operating, and return on equity components as well. As an analyst, you could argue that it's more effective to have some of these components in the operating section, or you could argue that it's more appropriate to have other components in the non-operating section. Our authors make the point here that service cost, for one, is arguably more related to operating activities. And I can see that point. So you might be purposeful about putting that in the operating section of your calculations. Slide number 46 here is particularly nuanced when we get into the classification of operating versus non-operating. If you look at the PBO, we're talking about future wage benefits, and wages certainly are operating, but there's a component of that PBO when we discount it back to the present value that's related to interest. You have to have the settlement rate or the discount rate. That's related to an interest rate that determines that. And as we know, interest rate is non-operating. So to separate those two things out can be particularly complicated. Our authors just mention it here on slide number 46 so that you will understand the nuanced nature of that. And for the purposes of this class, that's probably all the more detailed that we need to understand. And then, thankfully, and also for the purpose of this class, our authors give us one slide on other post-employment benefits, which is we call OPEB. So we just spent the last 30 minutes taking a deep dive into all of the components of a defined benefit pension plan, which are long-dated liabilities over a period of what could be 30, 40 years. Well, now imagine doing the same thing, only for healthcare costs. And rather than trying to forecast what wages are going to be in the future, which we probably have some handle on because we get control over that, well, now we have to forecast what healthcare costs are going to be in the future, which we have almost no handle on because we don't have any say-so over our healthcare system in the U.S. All we know is that we're going to be paying something to account for what we've promised our employees. And as an analyst, we need to be aware of that, but we also need to know that this does not show up on the face of the financials. It shows up in the back of the 10K filing, in the fine print. You're going to get similar disclosure tables, and that's about all the further we're going to go into it for the purposes of this class. So just look for those in the back of your filings and understand that those are other post-employment benefits, and they can similarly have huge liabilities associated with them. So find out what those liabilities are, find out if they're underfunded or funded, and what the company's plan is to meet those liabilities. Okay, let's move on. Learning objective number 3, analyzing and interpreting income tax reporting. Importantly, GAAP allows us to keep different books from the Internal Revenue Code. The Internal Revenue Code is driven by Congress, and Congress has certain initiatives that they want to push through from time to time, giving companies the opportunity to take advantage of certain tax incentives, and a lot of the accounting that's required by the Internal Revenue Code is going to be based more so on actual cash received and cash paid, whereas GAAP accounting is going to be more accrual based. And remember that accrual are expenses that we know we're going to occur in the future, but the cash hasn't actually gone out the door yet, and we've looked at many examples of those in the past. Like earlier in the semester, the primary example that we looked at was wages payable. That's an expense that has accrued but perhaps hasn't been paid yet. Depreciation is another example where GAAP accounting might differ from the accounting that's required by the Internal Revenue Code. The net effect of these differences is that companies keep two sets of books. There's accounting as required by GAAP, and there's accounting that's required by the Internal Revenue Code. That's the accounting that determines our actual taxes paid, and then the difference between the tax expense that shows up on our GAAP accounting and the taxes paid that shows up on our Internal Revenue Code is what learning objective number 3 is all about, because we have to be able to understand those differences, reconcile those differences, explain those differences, and then just like with everything else in this class, adjust any of the financials and subsequent ratios to make sure we have an accurate representation of what's going on. So let's dive into the differences between GAAP and the accounting for IRC. I'm just going to call it IRC. That's the Internal Revenue Code, or the IRS. I mentioned one of the primary examples being depreciation, and the differences in how we account for things like depreciation are going to create a deferred tax asset or a deferred tax liability. Deferred tax assets result when there's a mismatch between the IRC and GAAP financials. Deferred tax liabilities result when there's a mismatch between IRC and GAAP financials. And when one is bigger than the other, you have an asset, and when the other one is bigger than the first, you have a liability. Let's look at an example of that. We're going to start with depreciation. It's one of the more intuitive. The IRC gives companies the choice of straight line or accelerated methods of depreciation, and GAAP gives companies the choice. And they don't have to be the same. We can use accelerated methods for the IRS, so we can use straight line for GAAP, and when we have a difference, we're going to have a different depreciation expense. So in this instance, we're looking at a depreciation method for the IRC that's accelerated. And you can see here in this graph on page 51, the red line shows depreciation expense. In the beginning years, that accelerated depreciation is going to result in a depreciation expense that's much higher than straight line. Now think about the effects this is going to have on the income statement. GAAP accounting has a lower depreciation expense. Well, if you have a lower expense, you're going to have a higher income. Taxes for the IRS are going to have a higher depreciation expense. If you have a higher depreciation expense, you're going to have a lower income. And consequently, if you have a lower income, you're going to pay lower taxes. So for tax reasons, companies want to use this accelerated depreciation method. For other reasons, they may want to use a straight line depreciation. This is probably a better representation of the underlying economic reality. If you have a 5-year useful life or a 10-year useful life, you're going to get a more accurate depiction of your financials if you use straight lines, so that might be appropriate for GAAP. But for the IRS, for the financials that nobody but the IRS is looking at, if you can lower the taxes that you pay in year one, you absolutely want to do that, so you're going to elect the accelerated depreciation method. And the difference between those two accounting methods is going to create a deferred tax asset or a deferred tax liability, and we'll look at that here. In the example I just gave, where we're using accelerated depreciation for IRS financials, and we're using straight line depreciation for GAAP financials, we're going to have a larger tax expense for GAAP than we do for the IRS, and that's going to create a deferred tax liability. And this is one of those things that even 20 years into my life as a CPA and an accountant, and having taught this now for going on 5 years, every time I get to this lecture, and I don't know if it's just me or if this stuff really is that complicated, but I have to hit the pause button and mentally walk through very slowly the difference between a deferred tax asset and a deferred tax liability. And depreciation is a good example of a deferred tax liability. Let's go through the mechanics of that. So here we have financial reporting, GAAP, tax reporting, IRS, and we can see the differences work through the financials. So in year one, we have income before depreciation. In both instances, before the depreciation, we have $200 in income. Now the depreciation is going to differ because we have an accelerated method for tax reporting, so you have $75 in depreciation for tax reporting. Straight line gives us a $50 depreciation expense for financial reporting. That makes the calculation of income before tax pretty simple. $150 for financial, $125 for tax purposes. The income tax rate is 40% in both circumstances. So the financial reporting is going to record an income tax of $60. That's our expense. Now our tax report is going to record an income tax expense, which is the actual amount that we pay, because these are the financials that we're generating for the IRS. So this is going to be our cash paid is $50 to the IRS. That's what we paid to the tax man. Now there's a difference there. There's a $10 difference. So our net income is $90 for financial purposes and $75 for tax reporting purposes. Now let's take a look at how we reconcile those two different accounting treatments. And you can see that down here at the bottom, slide number 52. Well, we paid $50 in taxes, and we know that because we look up here at the tax reporting financials and we see $50 was paid to the IRS. So let's identify the cash account first. That's always a good place to start when you're looking at your debits and credits. $50 credit to cash. Now we know we booked a tax expense for $60. That's an easy one too. Expense accounts have a debit balance, so we've just debited $60 for tax expense. So what do we do with the other $10? Well, we know we're going to book a deferred tax asset or a deferred tax liabilities, and in this instance we know it has to be a credit to make our debits and credits match. Liabilities have a credit balance, so we have a deferred tax liability of $10. That makes our debits and credits match. And when we walk through that very slowly, it gives us a handle on exactly what we need to make that equation balance, and we can recognize that's a deferred tax liability. So why do we do that? Well, one of the reasons that we do that is it's known. We benefited from a difference in taxes payable and actual tax expense, the two different accounting treatments associated with that calculation in year one. But in year two or year three or year four, we know that's going to reverse itself. And because we know that will reverse itself in the future, we're going to book that liability today. And then when it reverses itself in the future, we'll remove that liability from the balance sheet. And we can see the effects of that here on slide 54, where we'll reverse that. And this is a very simplistic example because in this instance we only have 2 years worth of depreciation that we're booking. The first year was accelerated, and the second year that reverses, and that was the useful life of the equipment. So in this instance, we're in year 2 here. You can see the cash flows with GAAP and IRS. Income is 200. The depreciation reverses itself. The accelerated depreciation results in lower depreciation in year 2, so we have 25. Straight line is the same in both years. We have 50. Now we have a higher income for the IRS than we do for GAAP. We can see that the cash paid is 70 versus 60 for GAAP, and the net income is higher for the IRS than it is for GAAP, and that basic accounting transaction is going to reverse itself where we have a debit to cash of 70. Now we have, rewind. We have a credit to cash of 70. We have a debit to cash of, we have a debit to tax expense of 60, and that deferred tax liability is effectively wiped off of our books there as we have as we just debit that, resulting in a zero balance for that deferred tax liability. And importantly, all deferred tax assets and all deferred tax liabilities are temporary in nature and will reverse themselves in the future. Let's look at the opposite side of that equation. What happens when we have a deferred tax asset? So these arise when the tax payment is greater than the tax expense. You might just highlight that. Again, this can be confusing for students and instructors, as I've mentioned. When the tax payment is greater than the tax expense, we have a deferred tax asset. They represent future tax deductions. So just like a liability represented, a future tax expense that we're going to have to pay, these represent future tax deductions that we're not going to have to pay. And let's look at one of those in detail here. The examples our authors give us of a deferred tax asset results from restructuring accruals. You'll recall from a prior lecture that when a company announces a restructuring plan, they book the anticipated cost of that restructuring as a liability in year 1. Now, for the purposes of GAAP, you can deduct those expenses in year 1, but the IRS does not give companies the option of deducting those expenses until that cash is actually paid. And we know that most restructuring plans take place over a period of a year or 2, sometimes even longer, and that's going to cause those expenses to to string out over that period of time. When those expenses are actually paid, when that cash goes out the door, that's when the IRS says that we can deduct those from our IRS books. And that results in a difference between GAAP financials and Internal Revenue Code financials, and that difference results in a deferred tax asset. Another example of a deferred tax asset can result when a company books a loss. When a company books a loss, they don't owe any taxes on that, but the IRS gives them the ability to carry that loss forward into the future. So if last year a company booked a $1 million loss, and this year a company had $1 million profit, well, the IRS says that the company can take that $1 million loss from last year, carry it forward into the future, and offset this year's $1 million profit. So the net effect of that would be zero profit in the current year, and accordingly, the company wouldn't have to pay taxes on that. So when that happens, the losses from prior years represent a future tax benefit, and we can book that future tax benefit as a deferred tax asset on our balance sheet. Now there's some nuances associated with that, because some companies are never profitable. So if you ran into an instance where you have 2 or 3 or 4 or maybe 5 years or more where you're booking losses, well, you may be on a terminal track as a business, and the IRS takes a look at that, and they're going to require your auditors to make an assessment about the likelihood that you will be able to use some of those deferred tax assets in the future. And if the auditor comes in and they look at those deferred tax assets and they've seen them accrue over a period of years, if the balance is significant, they may come in and force you to take a valuation allowance against those deferred tax assets. And all a valuation allowance says is that, for argument's sake, let's say that a company has $1 million in deferred tax assets on its books that are associated with prior losses. A valuation allowance would effectively be the auditors coming in and saying, we don't know if you're going to be profitable enough in the future to take advantage of all those deferred tax assets, so we're going to make you decrease the balance of that account by some factor. Maybe all the way down to zero. Could be 80%, could be 50%, could be 20%. It's just a little bit of a haircut to more accurately reflect the probability that a company is going to be able to use that asset in the future. That's called a valuation allowance. Look for that in your financials. If the company that you're analyzing this semester has a valuation allowance that's offsetting a deferred tax asset, recognize that, because there's something significant going on there. The auditors have come in and they have forced the company to book that valuation account based on exactly that notion. We don't think you're going to be profitable enough in the future to take advantage of all those assets. Well, that's going to dramatically affect the forecast that you'll come up with for your company. So be mindful of that. So if you have a deferred tax asset on your books and your auditors come in and they require you to take a valuation allowance against that, that's the reduction in the value of that asset account. And as we know, anytime an asset account reduces in value, that has to show up on the income statement as an expense. Those two financial statements work in concert together. The income statement gives us some detail into the changes in the value of our assets and our liability accounts on our balance sheet. So if a valuation account is required, that'll show up as an expense. Well, periodically, a company's fortunes change. And here's an example that our authors give us of American Airlines. They had a valuation account on their balance sheet. They became profitable in the future, and the auditors came in and they basically said, well, you don't need that valuation account anymore. The economy has recovered, you're booking more flights, prices are going up. It would seem reasonable that you're going to be able to take advantage of this deferred tax asset in the future. And when that valuation account is no longer necessary, companies can book sizable gains. So you can see here that when that valuation allowance account reversed for American Airlines. They were able to book, I think this is a $3 billion gain that our authors are using in this example, so that it can be very meaningful. These deferred tax assets, they can be very meaningful to the fortunes of these companies. Here's the disclosure on slide number 60. We're always going to break that down into current and deferred. So here's how you read this. This is Exhibit 10.7 in Southwest's 10-K filing. The current portion is the tax expense determined from the company's tax returns. So this is what we're paying the IRS. Now the deferred, that's the exercise that we just went through. The difference between your IRS and your GAAP is going to result in a deferred tax asset or a deferred tax liability, and that's always going to be disclosed in the financials. And then the net effect of those two things are the provision for income taxes, and this is what's going to be on your GAAP financials. The components of your deferred tax liabilities and assets are going to be disclosed. So we reviewed 3 in this lecture, which was depreciation, restructuring costs, and any losses from prior years. There's a whole bunch of different examples in the tax code that can result in deferred tax assets and deferred tax liabilities. Look for this schedule, which will disclose all of the major categories. In this instance for Southwest, we have deferred tax liabilities and assets that have resulted from the accounting treatment as it relates to derivatives, operating leases, construction obligations. These things can get very nuanced. So we're not going to go into all of these categories for the purposes of this class, but just know that the accounting treatment can differ across a wide variety of different accounting. You're also going to see a table in the back of your 10-K filing that will detail a company's effective tax rate. You hear a lot of times that no company ever actually pays the effective tax rate. Well, that's true because most companies operate in multiple municipalities. They're subject to state, they're subject to federal, they're subject to foreign government taxes. They're using different offsets and different tax credits, and there's a difference between the IRS and the GAAP. And there's a table at the back of the 10-K filing that in this case is Intel's, that shows the statutory federal tax rate here at 35% and the offsets that Intel books for, here one is non-US income taxed at different rates. Okay, well that has an effect. Settlements, effective settlements and related measures, domestic manufacturing offsets, research and development tax credits, so on and so forth, that result in an effective tax rate of 19.6%. Know that effective tax rate, because later in the semester when we get to talking about discounted cash flow analysis, we're going to need to be able to forecast our financials into the future, and we're going to use the effective tax rate to do that. Now look at how it fluctuates though. In 2013, Intel's effective tax rate was 23, then it went to 25, then it went to 15. What's it going to be in 16, 17, 18? We need to have some basis for coming to a conclusion about what it's likely to be in the future, because that's going to be crucial to the forecast of our financials out into the future for our discounted cash flow analysis. So this table will help inform us and help us make that forecast. So here our authors give us an example of just how we would use that information to inform our decision making. In 2015, they note that Intel settled tax disputes that took 2.9 percentage points off their effective tax rate. That's not likely to occur in the future, so we want to discount that. And when we look at last year's 19.6, we might note that and say to ourselves, well, because that's not likely to recur in the future, a better estimate of Intel's tax rate would probably be, what was it, 2014 or 2013, when they had an effective tax rate of 24 or 23. That might be a more accurate indication of what we're likely to see in the future. So we might want to forecast 24 to 26, maybe 26 on the high end, just out of the principle of conservatism. And then lastly, here on slide 64, our authors are just kind of recapping a couple of the points that we've made regarding deferred tax liabilities and valuation allowances, noting how these have a tendency to reverse themselves over time. So then we move into the appendix. I'm not going to cover that in this lecture series. So this will end the lecture on Module 10, and I'm looking forward to seeing you in class. Thanks all.